there still actually is a reason to have these monetary masters of the monetary universe, these central planners, whatever it is, they try to hike rates. And what happens is you force the marginal borrowers into default. Because every time it ticks down, the new marginal borrower is somebody who's borrowing only makes sense at that lower rate. And then you try to raise the rate, and then all of that borrowing is now rendered submarginal. It can't be supported. Let's say the interest rate's 5%. You own a chain of 172 hamburger restaurants, and you're always looking at the 173rd. And it doesn't
Right.
make any sense at 5%. The spreadsheet, you calculate your whole model, and the spreadsheet is red ink at the bottom. And then they lower the interest rate to 4%, and ding, the red ink turns to black ink. And so you borrow a couple of $1,000,000 to build this thing, and it only made sense because the rate ticked down. It's not because the demand for hamburgers went up. It's not because your area increased in population to the point where it could support another hamburger restaurant. It's that the interest expense on the new store went down. Now,
Right.
if they hike the rate, your store is now suddenly non-viable. It's going to go right back to where it came from, which is it can't exist. The problem is if there's a lot of businesses that have borrowed, and then you suddenly render them, bankrupt, then that is going to be a lot of defaults that hit the banks. And then you have defaults hitting the banks, so what do the banks do? The banks pull back, and they won't renew other loans, which means other borrowers get into default. And so you get this vicious cycle of defaults. Defaults beget defaults. In 2008, I heard a term that was new to me at the time, and maybe economists have been using this since forever, maybe not, contagion. Like it's an infectious disease, like it's a spread of bubonic plague or something like that. And then it just spreads and spreads and spreads until eventually it would wipe itself out, or if the entire system is over leveraged after 40, 30, what is it, 30, 37 years of, irredeemable currency and all that. Maybe it wouldn't, and it would just wipe out the whole system. So then they have to, I liken the analogy to, there's the legend of the kid, the Dutch boy in the dike, and the dike springs a leak. So he plugs it with his finger until the villagers can come and repair it. Now imagine the dike is springing 1 leak and 2 leaks and 4 leaks and 16 leaks and 256 leaks and 16,384 leaks. Imagine this army of kids all plugging the leaks, and
Yeah.
that's the central bank trying to fight a 2008 style crisis. And so I think the term soft landing means that they lower the interest rates and they increase, the various monetary spigots and fiscal spigots the government can spend, and all that extra revenue hits these businesses and props them up. And soft landing is when the government reacts sufficiently big and sufficiently fast to, have too much contagion, and then a hard landing is if they let it go too far, or it's too late by the time they try to jump in, and then that's a hard landing. But both of those are kind of false alternatives. Within a larger false alternative. So the first false alternative is, okay, why did you raise the interest rates in an
Yeah.
environment where that's mechanically impossible? And then the bigger false alternative is, why do we have irredeemable currency in the first place that necessarily leads to an unstable interest rate that will trend forever, and and so on. But within that, you have hard and soft as kind of two flavors of bad, depending on, it's what it is. Two different flavors for your shit sandwich, I guess, to make an analogy of that.
Or fish ice cream and turkey ice cream.
Did you ever see there was a meme going around? Somebody had photoshopped Lay's potato chips and created all these really unattractive flavors: orange juice toothpaste, and that was one that really got me. Couch was another, um, and was another one that was just really. Anyways, it was a whole bunch of them.
uh, Keith, I wanted to get your thoughts on the dollar and dollarization. I read a recent Financial Times piece that painted the Trump team as, pretty much launching a kind of a dollar fight club 2.0, exploring ways to get other countries to adopt the US dollar, basically a global push for re-dollarization. I think the term was pro-dollarization or dollarization. And Professor Steve Hanke thinks we're more likely to see a world re-dollarize than de-dollarize. Keith, what's your take on that? Are we moving away from the dollar back towards it, moving into a multi-currency world? What are we? Where's the dollar going?
I differ from most folks in the gold community in that long before Trump and this particular episode, I have been in the dollarization camp, um, and I have a couple of litmus tests. The first, I call it the taxi driver test. Suppose you take a taxi somewhere and you offer the guy dollars, even though some other country where they don't use dollars. Is the dollar going to be rejected? Is there going to be anger? Will he take it happily with a smile? And I mean, I think a lot of people realize if you go to some place where they have some benighted peso, the banana republic, and you offer them dollars, of course they're happy to take it, which is part of the story, right? That's the places where dollarization will happen. It happened to me in Switzerland. I took a taxi. Now I normally get by a credit card. I don't generally go and bring a whole bunch of dollar cash and then go to the airport and the currency exchange place and trade it for local cash. Too much of a pain in the butt, and everybody pretty much takes credit cards nowadays. Everybody except this particular taxi that I got in Switzerland, cash only, and I was like in a real bind. Now the fare was I want to say 20.2 francs. At that time, the franc was I think $1.03 or $1.06, so that was a bit over $20.
Yeah.
And all I had was a couple of $20 bills. So I took out a $20 bill, which is a little bit short of the fare, but that's really all I had. And it's like, I was kind of in a bind. Anyway, he smiled and he was so happy to take the $20 bill. This is Switzerland, which is supposedly the best paper currency, right? Well, he was happy to take dollars, even at a bit of a discount relative to what the fare was. I think the world is absolutely, the big population countries. You think India, China, to name two. Turkey's not that small. Brazil, definitely not that small. They have capital controls. Brazil, a little bit less so. Officially they don't, but if you really want to take, $1 million out, you're going to find you can't. They lock their people into the currency. Now, what is that telling you? And the people there all want dollars, not allowed. And in China, they risk their lives. I mean, when they hire, like in the U.S., when you hire an financial advisor, if you're a client at a big bank, you hire a wealth advisor. That guy's job is to really sort of, it's like half marriage counselor and half portfolio allocator. It's like, okay, how old are you? And, what are your goals? And how much you think you're going to be making not only this year, but the next 10, 20 years, and okay, we think you should have this much in bonds and this much in equities, a little bit of real estate, whatever. And in China, that's also their job, but a big overlay of that is they help you navigate the capital controls. Everybody in China of any degree of wealth is trying to dump their yuan and get dollars, and it's illegal. Now, in a place like that, when you break a law like that, if they catch you, it's not like, okay, $10,000 fine. It's like they can disappear you to secret prison and beat you within an inch of your life. I mean, bad things can happen, and they're all risking it to dump their yuan and get dollars. And I think that the government there is terrified what would happen to the value of the yuan if the people were allowed to dump as much of it as they wanted to. So I think this has been going on for a long time. And then you look at India and Turkey. Now, India is not a hyperinflationary case at the moment. It's just a regular inflationary case where the rupee goes down. I think it's 8% per annum against the dollar. And it's not like the dollar is going up against anything real. In Turkey, it is on and off threatening hyperinflation. These people, absolutely, if they could, would have more dollars. So they can't. They buy gold. They do all these things, right? Now, I think what the story is referring to is dollar stable coins. And it's much harder for a government to block a crypto token because it's the nature of crypto is it's an end run around certainly banking system regulation, central bank regulation, right? You buy what you want. And I think what's going to happen is if dollar stablecoin tokens become widely available in places like Turkey, like India, like China, there will be a heck of a lot of capital that drains out of the currency and into the dollar. Boy, what a perfect storm for other currencies. And so in my view, the dollar will fail last
Right. Right.
after all the other currencies fail first. And of course, the first ones to fail are going to be the marginal ones, the Argentinian pesos of the world and the Turkish liras of the world. And last will be, the dollar in the end.
Hmm.
So yeah, re-dollarization or dollarization absolutely is a real thing.
Keith, do you see the U.S. actually succeeding to nudge countries like Argentina to dollarize? And if the dollar's strength grows globally, what does that mean domestically and abroad? And how does it affect gold? Does a stronger dollar weaken gold or make gold even more important?
So I'll take the second part first. I argue that how I mean measuring the dollar in terms of the other currencies is a bit like measuring Apple by Apple call options. Apple went up 20% today because now it takes
Yeah.
120 Apple call options to buy a share of Apple, and it used to take only 100 Apple call options.
Yeah, yeah.
The other currencies are dollar derivatives. You're measuring it, exactly backwards.
Mhm.
But even if you look at the other currencies as going down rather than the dollar going up, I don't really see that necessarily being correlated to um, the price of gold in dollars, which is also inverted. It really should be the price of dollar in gold, 7.5 milligrams or whatever it is right now. So that, yeah, every dollar, you take 7.5 milligrams of gold to buy a dollar is really how we should look at it. And I don't think those two really necessarily correlated. Now, what was the first part of your question was about a higher dollar relative to the other currencies. What does
Yeah.
that do? So here's the challenge. If you are a substantial corporation, whether you're in Turkey, India, China, wherever, the funding market will be happy to lend you dollars, if you're credit worthy, but not so much the local currency because people don't want to take the local currency risk, which means you have dollar debts. Right, so the dollar is reserve currency because people hold it in reserve, not because the transactions happen to be denominated in dollars. Yes, it's true. When oil is sold, it's
Hmm.
denominated in dollars, but more importantly, all the
Hmm.
oil producers have dollar debt. And so if you are a producer of I don't know, you're a baker, a big baker in India, and you bake bread, um,
Right.
and the dollar goes up, which means the rupee goes down. Your revenues are in rupees. You're selling bread to Indians, and they're paying in rupees. So your
Hmm.
revenue is going down in dollar terms, and yet your debt is fixed in dollar terms. That's a squeeze. You are getting absolutely squeezed. Um,
Hmm.
and the rest of the world, experiences real pain when this happens. And so there's kind of a perversity. On the one hand, the dollar is on the asset side of their balance sheet, especially for the central banks, and they hate it when the dollar goes down relative to the local currency. There was somebody, I think this was France, was arguing with the U.S.